So what if I told you that you could be making a mistake on your retirement that could cost you more than half of the potential retirement income that you'll get in retirement? Well, if you want to know what that one mistake is, stay tuned because we're going to talk about it in this video. Let's get started. My name is Jason Canady. I am the founder of the Canady Financial Group. And for the past decade, we've been helping medical professionals, educators, and others to increase their retirement income and create a better financial outcome. One of the ways that we do that is by creating content, educational videos like this one. And so if you haven't done so already, please subscribe. We always appreciate the support. And as a result, you'll know when we post the next video. Now, we want to get into what this mistake actually is that a person could be making. Now, to illustrate it, I'm going to share my screen and I'll draw it out so that you can follow the train of thought that I'm going on. Okay, so I want you to imagine two retirees, okay? One retiree did what everyone else does, traditional retirement. They saved all of their money inside of their 401k. They did what all of the financial media and the supposed gurus told them to do. And so now they have this big bucket of money inside of their 401k. Now, for this example, it really doesn't matter the amount, but we're just going to pick an amount, right? We'll pick a relatively small amount compared to what some people's goals may be. We'll just say 500,000, right? So let's say a person has saved up $500,000 inside of their 401k, and then we have another person who has also saved up $500,000, but they've handled it differently. Instead of having all of their money in their 401k, they've sought out various different income producing assets. They've diversified into different tax positions. And what you're going to see now is you're going to notice a major difference in what happens when they access their money. So for this example, we're going to assume that this 401k is not the person's only source of income. We recognize that many people have Social Security. Some of the teachers we work with might have pensions. I know that's not the case for medical professionals and business owners, but the teachers might have a pension. And there may be other sources of income that exist. But nonetheless, we're going to assume that they're going to use this money they've saved to add on top of their income. Now, money that is invested in the market traditionally in a 60-40 stock and bond portfolio, you're often restricted to a certain retirement rule called the 4% rule. Now, basically what this rule means is that in order to give you the peace of mind and the confidence of knowing that you won't run out of money, you need to stay close to the withdrawal rate of 4%. Now, some people might do a little bit more, and there are many people saying you should be doing less. So we're not going to debate whether it's 4, 5, or 3. We're just going to stick at 4, right? But here's the point. If you're only taking out 4% of this 500,000, that means every year you can only take about $20,000 out of your retirement account. Now, if all of this money is in a 401k, you're not just bound by this rule, you're also bound by another issue. And that's taxes. Remember, you didn't pay taxes on this money. So now let's just assume a modest tax rate of 10%, right? I'm sure most would agree that they have a major chance of paying more in taxes than just 10%, but we'll just assume, just to keep it simple, let's just say 10%. So that means that we're going to have to take $2,000 from this, and forgive me for my my horrible handwriting. I'm sitting here drawing this, but hopefully you're getting the point. So now, because your money's exposed to risk, you're restricted to this safe withdrawal rule, and you have to pay taxes. So now you're receiving $18,000 a year from this $500,000 you saved. Now, is that the highest possible income that you can get from $500,000? No. Let's look at the other person, right? So we have this other person here. They have the same 500,000, but they have diversified their accounts, right? So they still have a 401k. Maybe they have some money in Roth. Maybe they have some money in life insurance so that they have a place to go when the market is down. As a side note, that's why that 4% rule exists, because if the market goes down the year you're supposed to take money out, then your account may never make it back up. But a person who's using various different assets, they have a place to go when the market is down so that they don't have to tap their market accounts when they're down. Now, the combination of having a safe place to access money means that they can increase the withdrawal rate on their $500,000, right? So now they can take, for example, 6%. And another thing, if they have diversified between these accounts properly, the IRS has what's called a standard deduction. Basically, what the standard deduction is an amount of money that they automatically subtract from your income. So for the average married couple, that standard deduction is $25,000. What that basically means is every year you get to write off $25,000, as it were. So if you make $25,000 in a year and you use the standard deduction of $25,000 as a married couple, then basically you didn't make anything that year. Okay, what's my point? If your assets are designed correctly, then you could make sure that you only take enough out of your 401k to the point where you reach that standard deduction. That means you pay no tax on that money. Everything else comes from your Roth IRA, your life insurance, your other assets. That means not only do you get to take 6% out, you also don't have to pay taxes. So now we just took the same $500,000 and they're able to take 6%. They're able to take $30,000, right? So which would you rather have? Would you rather have $18,000 or $30,000? Well, to have the $30,000 is going to require that you diversify. If you're only saving money in a 401k, now is probably the time to look at some other options. And obviously, I'm not giving you personally advice because I may not know who you are. You may not be my client. So don't take full advice from someone on YouTube. Consult your financial advisor or reach out to me. But the point is that there are certainly ways to structure the money you've saved so that you get the maximum amount of income from your money so that you can be comfortable in retirement. So hopefully this short little video uncovered a mistake that millions are making. My mission in some regards is to try to inform individuals to diversify. Let's stop putting everything in one basket and look at other different options that we can put our money into. If you have any questions or you want my help in acting a strategy like this, click on my calendar link in the video below, subscribe, like the video if you appreciate it. Let us know in the comments as well. We look forward to being able to talk to you again soon, and take care.